You know, I've been waiting a while now to make this video to wait to see how the response would play out, but now it seems like the pressure is really on, with several groups coming out in the media saying that Freeland's big decision here was a big screw up. You see, hidden inside of the fall economic update, one of the two updates we get throughout the year that tells us what the government's planning on doing with its money, well, inside of that fall economic update, there was a small little section that said a particular investment strategy used by many was essentially discontinued moving forward. And some believe that, in fact, this decision and its inclusion in the economic update from the Department of Finance signals that they've lost faith in the Bank of Canada's ability to achieve its goals over the next year. So why don't we talk about what this lucrative investment strategy is, or I guess was, the tiny section in the economic update that cancels it, the less than believable excuses that the Department of Finance gave for making this cancellation, as well as how this could all impact the average Canadian. So let's dive right into the information, and make sure to subscribe to the channel if you haven't already done so. That is the best Christmas gift that you could give me or the channel, just a free click of that subscribe button if you haven't already done so. Let's take a look at this. This is the small little section inside of the fall economic update that cancels this investment strategy. It's called the Real Return Bond Program, and inside of the update it says the government has decided to cease issuance of real return bonds effective immediately. This decision reflects low demand for the product and will allow the government to promote liquidity by consolidating funding within our core funding sectors. In order to understand all of that jargon, along with why there's such a commotion about the cancellation of this program, you first need to understand what real return bonds are, and I promise you, once you understand this, everything else is going to make a lot more sense. It might look complex, but I promise you it's super simple. We're going to sort of look away from real return bonds for a second and just start with the basics. What are bonds and how do they work? And there are all different types of bonds, and some of them function a little bit differently, but today we're talking about specifically Government of Canada bonds. You see, the Government of Canada issues these financial products in order to raise money for government operations, right? This is how they borrow money from the market, by issuing Government of Canada bonds, which are essentially just an IOU. They're promising people who buy these bonds that, hey, you give us this money for a set amount of time, and we'll give it right back to you at the end of that set amount of time with a little bit of interest along the way. So using this sort of hypothetical bond as an example, if you were to put $1,000 into this bond, well, the government would pay you a hypothetical 3% interest rate along the way. Now, most Government of Canada bonds pay you out twice a year for the interest earned. So if you put in $1,000, well, then you'd earn $15 every 6 months, or $30 for the entire year. That's 3% of $1,000. So all right, that's pretty okay for an investment. You're getting 3% on the year, but when you think about inflation and taking that into consideration, well, the investment doesn't look quite as good, right? Because if we're experiencing higher inflation, the measly 3% you're earning on your money, which is lower than inflation, doesn't seem all that great, and you have to lock up your $1,000 that's losing value to inflation each and every single year for the duration of those 5 years, or whatever the maturity of your bond is. But that is exactly where real return bonds start to come into play, and it solves for this exact situation. You see, real return bonds are a special kind of bond that works very similarly to the bonds we just discussed. They'll pay you a set interest rate. You got to lock up your money for a set amount of time. You'll get those interest payments twice a year, like most other Government of Canada bonds. But the difference here is the principal, or the amount you put in at the very beginning, this $1,000, that is indexed to inflation. So let's just say, to make the math easy, if this $1,000 was sort of put into this real return bond and we experienced inflation of 10%, well then, okay, the next year this real value would go up by 10%, leaving us to $1,100 as your principal, and you're going to earn your interest over the 5 years on that newly adjusted principal that has increased at the same rate as inflation. So perhaps you're starting to get an idea of why the Government of Canada might not want to continue to issue these real return bonds, especially in an environment where inflation is high and interest rates are high. But let's take a little bit of a closer look here. You see, there's a small section inside of the fall economic update that we got from Christopher Freeland in the Finance Department called Public Debt Charges, where they explain how the amount of payments that we're having to make towards Canada's total debt changes over time. And this is what they said just as of this November. Public debt charges are expected to increase to $34.7 billion in 2022 to 2023 due to the sharp rise in short-term interest rates and the impact of higher inflation on real return bonds. But they say, don't worry, these public debt charges are actually rather low in comparison to how they have been historically, not in terms of the amount that we're paying, but in terms of the amount we're paying relative to our gross domestic product, or the sort of sum of all the productivity in Canada, all the sales of goods and services. That's what goes into our GDP. And what Christopher Freeland in the finance department is saying is, okay, even though these costs are going up to service our debt as a portion of the amount that we make in a year, well, it's actually not all that bad, because we're only at 1.5% of GDP for our debt servicing, whereas back in the 1990s, we reached a peak of 6.5% of the total yearly income of Canada, the GDP, going towards paying the interest on our debt. So the government of Canada is saying, hey, we don't really want to continue this program where people can sort of protect their money from inflation, because it's going to cost us a lot of money, because we have to increase the money that we give them back at the end of their bond relative to how much inflation increased over that time, right? But they do have other excuses that they've sort of included in here to sort of murky the waters as to the real reason why they canceled these bonds. You can see it right here in the initial statement that we went over. They say the government's decided to cease issuance of these RRBs effective immediately. And the reason they're giving here is that, there's actually low demand for these real return bonds, and there's not enough liquidity in the markets for these real return bonds. Liquidity just being how many sales and purchases back and forth between different people are there. And they also say, hey, you know what? We did these consultations over the past year, and as a result of the consultations that we've gotten a better idea that maybe we don't need these RRBs anymore. They say that there's generally good demand for almost all of Government of Canada debt issuance sectors, so all of these different bonds that the Government of Canada issues, with an exception on 3-year bonds and real return bonds, the ones we're talking about today, where demand and liquidity have been relatively weaker. Essentially, less demand in this market means, hey, maybe people don't want it as much. At least this is the Government of Canada's idea. They also say that inside of this survey, they've gathered intel that the general market would rather Canada have broader sustainable bond frameworks that includes social and transition bonds, as well as green bonds, sort of to promote certain social issues and to raise money for the green transition. But now big groups of people are going to the media saying, okay, the Department of Finance's reasoning for canceling this real return bond program is inaccurate and at the most extreme just untrue entirely, and that it could have big impacts on Canadians across the country. The Canadian Fixed Income Forum, which is a sort of a group of market representatives, people from several big banks, pension plans, provincial governments, and fund managers, well, they met as part of this Canadian Fixed Income Forum, and these are the notes of what they discussed at their most recent meeting, November 29th in Toronto. And they took issue with a number of different things that were related to this cancellation and the way the government was framing this, saying that inside of the consultation that they referenced as part of the reason for canceling this real return bond program, that inside of that consultation, no questions were related to the cessation of RRB issuance or just stopping the RRB program. On top of all this, contradicting what the Department of Finance said, several members said that demand for these real return bonds has increased across the curve in the current higher inflationary environment, which makes sense. If you have high inflation, something that protects you against inflation would have more demand, and that they expect the demand to increase further as Canada's population ages and people are investing in less risky things as they get closer to retirement and are depending on things like bonds and other fixed income investments. Also, a pension plan manager who made a comment in this recent Financial Post article said that typically all of these issuance of real return bonds are actually oversubscribed, meaning there's more demand for it and people want more of them than the government is willing to issue. And he adds on that infrequent trading of these real return bonds does not indicate low demand, and most long-term investors, such as pension funds, tend to buy up these real return bonds and just hold them, which is part of the reason why these markets don't have as much liquidity, which is one of the reasons the Department of Finance cited as being a reason for canceling these real return bonds, is that, hey, these marketplaces aren't efficient, there's not much liquidity, there isn't enough people trying to sell them for the people wanting to buy them, there's not as much active trading going on in this marketplace. Well, the reason is people don't want to sell them, they like them so much. They also said that a bunch of people are kind of getting screwed by this sudden decision without consultation because there are many inflation-linked financial products, things like ETFs that consumers can buy into that hold these real return bonds inside of them and essentially protect them from their exposure to inflation. They say that because there's no more new real return bonds, there's going to be far less bonds that these type of exchange-traded funds can buy up to hold inside of their portfolio. And this could mean that the costs to manage this portfolio or to sort of manage the ETF, maybe the management expense ratio for the ETF could be higher, meaning that the end user, retail customers, end up paying a higher fee on the management of that financial product. An example of this is XRB, which is an iShares Canadian Real Return Bond Index that just essentially holds a bunch of real return bonds, and you can see that they're issued by, when I get down to it, the Canadian government, and some from Ontario and Quebec as well. In order to sort of manage this portfolio for the people who are holding this exchange-traded fund, well, it's going to get a lot more difficult because there's no more new RRBs that you can buy. You just have to trade in the old ones. They also warned Freeland and the finance department that they're kind of screwing themselves over, maybe shooting themselves in the foot a little bit here if people lose confidence in the process that Canada issues these bonds, right? Here's an example. Some feel that the unexpected cancellation of the RRBs, as well as the ultra-long bonds that they were planning on putting out earlier, could lead to less demand or participation and faith in the Government of Canada bond market, meaning that the Government of Canada itself could have to pay higher interest rates on the bonds that they do issue because there's less demand for people to buy up these bonds in the first place. Now, these notes from the Canada Fixed Income Forum end with this sort of conclusion that they're going to push back on this decision from Finance Canada and say, okay, we want you to reconsider this. Can you change this? And also they say that more efforts should be made to educate investors on the benefits of the product and how it works. And I think that's actually one of the most interesting things they've said. While real return bonds, especially in periods like today, can be a powerful tool for Canadian investors, well, a lot of people just don't know about them and don't know how they can access them. And we can see that also in the National Bank of Canada report here. It's actually a response to this cancellation, them saying that, let me see it here, domestic pension managers have from the beginning been key players using RRBs to match long-term inflation-sensitive liabilities, and that it's more of a niche market, and that it's on average not the average retail consumer that is taking advantage of these real return bonds, but instead it's mostly pension fund managers that are able to use this product because, well, they know about it. This, interestingly, brings up the counter-argument for this, the argument that says it's actually a good idea for the Government of Canada to cancel these real return bonds. Perhaps it's only the wealthy pension funds and the corporations that are able to access these real return bonds that are benefiting from it, and maybe the Government of Canada should cancel these real return bonds because it's the Government of Canada paying the higher interest rate that largely pension fund managers are benefiting from. Even though most of these pension funds are serving customers that are retail Canadians, public sentiment might not be that great for big corporations and these pension funds getting paid more because of inflation from the Government of Canada, while at the very same time, the average Canadian's purchasing power, their average dollar, is worth a lot less due to the very same thing, the impact of inflation on their money. But I think the biggest impact here is what this says, or at least displays, about the way the Department of Finance in Canada feels about the Bank of Canada. And it makes me ask the question, what does the Department of Finance know about the Bank of Canada that we maybe don't? Chrystia Freeland in the Department of Finance and the Canadian government at large has talked a lot about the importance that Canadians believe in their institutions like the Bank of Canada, and this actually has real results on the Bank of Canada's ability to do its job, right? If Canadians don't believe that the Bank of Canada can get inflation under control, well, then that could make inflation even worse in the long term, because if you think there's going to be inflation tomorrow, you're going to buy your products today because they're cheaper today. That's going to add more demand and sort of be this cycle increasing inflation, right? More demand today because tomorrow it's going to be more expensive means that tomorrow it's going to be even more expensive because of all the excess demand today. But at the very same time, they're saying, Canadians, you should believe in the Bank of Canada's ability to look strong and look like they're going to tackle inflation and raise interest rates and inflation is going to go away. You should believe in that, but we're going to signal through this decision that, hey, maybe we don't believe that they're going to bring inflation down because they're canceling a product that costs them more when inflation is high. Do you see see my point here? It kind of signals that the government of Canada doesn't have full faith that the Bank of Canada is going to get this back under control. Inflation is going to go back down to 2%, and at that rate, real return bonds aren't costing the government of Canada all that much additional. So why wouldn't they just let the program run out how it has been for the past 20 years? Especially for organizations like the Bank of Canada, you have to really read between the lines and look past what they're saying, because they use what they say as one of their tools to impact the Canadian economy. They sort of present a facade to make it look like they're going to do something, because that perception that they're going to do something, and it will actually do something in the economy if enough Canadians believe it. So that's why you sort of have to read between the lines and sort of see, okay, what do they actually think? What does the government of Canada actually think? What are they saying versus what are they doing, right? But I'm curious what side of the debate you land on for this. Do you think that real return bonds should be more broadly available to Canadians and that they should continue this program? Or do you think that perhaps because it's not mostly retail and average Canadians that are protecting their funds from inflation with real return bonds, and instead that it's the big pension plans and potentially big corporations that are able to access these bonds? Well, do you think that, hey, maybe we should just do away with the program entirely so that we're, as Canada, like the government of Canada, so that they're not paying increased amounts of interest to these larger corporations? What do you think about all this? It's kind of a tricky situation. Let me know down in the comments. I read every single one. I try to get back to as many as I possibly can. And again, if you haven't already done so and want to give me a Christmas gift, you can click that subscribe button if you haven't already done so. It helps out the channel dramatically, and I appreciate every single one of you that has done that so far. And with all that said, thanks so much for watching, everybody. I really hope this video helps you out at least a little bit, and I'll see you next time.